On Point with Craig's Investment Partners.
All right, good morning, all. Remember, as always, the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So, before you make any decisions, we recommend you contact an investment advisor. And for more information about our services in that regard, you can visit our website, which is craigsip.com. All right. First up, apologies. I've got a bit of a croaky voice, just trying to shake a bit of a cold that I've had for the last few days. So that's why I sound like I do. But I wanted to talk about the housing market today. We're starting to see a few signs of life across the housing market. Anecdotal evidence from across the country does suggest that we might be starting to reach the end of those falling prices. And we've had a few bank economists lately as well start to call the bottom. So I think that's really important. I would agree with those views. After falling for the past 18 months, it is starting to look like we are reaching the point where the housing market will stabilize, which is obviously a good thing. That will be a great comfort to many homeowners who have watched their biggest asset fall in value over the last year and a half quite significantly. And I think the point where house prices do stabilize and find a base will help confidence generally and help sentiment, because for most of us, the house is the biggest asset, or at least one of the biggest assets. And when it's falling in value, it doesn't do wonders for how confident or how wealthy we feel, and that impacts our behaviour. So when house prices are at least stable, they don't have to necessarily be rising again, but I think stability will boost confidence, make people feel a bit better about things, and just will improve sentiment across the board. So I think from an economic perspective, that's a good thing that we do feel like we're approaching that point. At the same time, I wouldn't get your hopes up about house prices taking off again anytime soon. I think there's a big difference between the market stabilizing and the market sort of moving into another period of strong capital gains. I'm not sure that is upon us, at least not for the near term. But if we look at where prices have moved, and I like to use the Real Estate Institute figures. Those are, very credible, and they strip out a lot of the noise. So when I'm looking at prices, I'll use their house price index, and the reason I like that rather than looking at things like median prices is median prices can move around a bit if you get sort of different parts of the market seeing more activity than others. So, say you have less activity this year in the lower end of the market, but you've got some of the more expensive houses out there selling, that can sort of drag your median price up and give you kind of an artificial picture of what prices overall are doing, or vice versa. So I think things like the house price index that the Real Estate Institute does is a very credible way of looking at where prices have gone. And their national house price index peaked in November 2021, so about a year and a half ago. And since then, we just got some data out this morning with the latest numbers for the month of May. And since then, since that November 2021 peak, it's fallen 18.1%, which is a hefty fall. That's a big fall. The Reserve Bank has house price data on its website going back to 1962. So many, many years, decades. And there's never been a bigger fall in nominal house prices over that sort of time frame. In adjusted inflation adjusted terms, we have seen falls as big as that and worse. Um, but not since the late 1970s, sort of early 1980s, and that was the period where you had nominal house prices were going sideways, but because inflation was so high in inflation adjusted terms, house prices were actually falling quite sharply. So um, the period that we're in now, that we've seen over the last 12 or 18 months for the housing market, has been one of the worst that we've seen ever. Certainly we haven't seen anything like it since that period in the 70s. So the falls have been sharp, and more than most of us have seen in our lifetimes, in terms of that peak to trough decline, down 18% in nominal terms, and more than that in inflation adjusted terms. However, that doesn't mean that prices are good value. Just because they've fallen a lot doesn't mean they're cheap. Far from it. You've just got to remember how much prices rose during that low interest rate era of the pandemic. 2020 and 2021, where you had the zero interest rates, pretty much zero. The OCR was at an all-time low of 0.25. You had QE, or large scale asset purchases, whatever you want to call it, money printing. A lot of people call it that. It isn't quite money printing, but um, not too far off it. So during that era, and this is pretty much leading up to that November 2021 peak, in the 2 years leading up to that peak, national house prices increased 47.5% in 2 years, which is phenomenal. And if you look at the 30 years before that, so the 30 years leading up to that those 2 years of the very low interest rates, house prices increased by an average of 5.9% per year. So that's if you're looking for what's a normal increase in house prices, then pretty much the last 30 odd years since 1990, um, that's what you would consider normal. 5.9% per annum, and inflation's probably averaged 2 or 3%. So the real house price growth has been about 3% ish, maybe approaching 3.5 though. So that's normal. And in 2 years, we saw prices go up 47.5%. So even though we've seen a big fall, you've just got to remember how sharp that increase was. And when you put it in that sort of a context, the 18.1% decline that we've seen really only, it just sort of takes us out of the stratosphere in terms of where prices got to. So prices are only, even though they've fallen 18.1%, they're only back at January 2021 levels, and they're still 20% higher than they were before COVID. 20% higher than those late 2019 levels, before we'd all sort of heard of COVID, and before we had all that stimulus and those interest rate cuts and so forth. So I guess the point I'm trying to make is that even though prices have fallen hard, they've fallen from such a high level that prices are still, property is hardly a bargain. It's simply less overvalued than it was, a year ago, 18 months ago, 2 years ago. You get a similar story when you look at rental yields, and the Real Estate Institute does a 6 monthly report with where rental yields are at. And the most recent one, which sort of covered up till the beginning of this year, rental yields in Auckland, and this is their figures, not mine, so it's public information. Have a look on their website. The Auckland rental yield 2.9%, the Waikato 3.3%, the Bay of Plenty 3.5%. So not hugely exciting, is it? You wouldn't look at those numbers as an income investor and think, well, that's fantastic. Great deal there, lots of opportunity. Remember, you've got to take costs off that, whether it's property management fees, rates, insurance, maintenance. So those numbers will come down. You'll still get a capital gain, hopefully, but you would have to be getting a pretty hefty capital gain to offset those very low levels of income. So I don't think we're at the point where we can start getting excited about the housing market being reasonable value, even though we are starting to see, the point of stability approaching in terms of prices. We've also got to think about the prospect of a slowing economy and rising unemployment. Now, those things aren't terribly good for asset prices across the board, and the housing market, just like the share market or other assets, the housing market doesn't do terribly well when you've got higher unemployment. People start to feel a bit nervous about whether they can pay the mortgage and their financial situation. So that can be a bit of a headwind. And we haven't seen a significant rise in unemployment just yet. It's still sitting at very low levels, but the Reserve Bank, its forecast suggests that unemployment will rise to 5.1% this time next year. So that's a big increase from today's 3.4. Now they might be wrong, who knows? But I suspect that you will probably see unemployment drift higher to some degree, and that also could limit the extent of a rebound in the market. And um, so that's one handbrake that we've got. Mortgage rates as well, also at the highest level since 2008, and they won't be there forever. Interest rates won't be at these high levels forever. If you look out 6 months, 12 months, certainly 18 months, they probably will come down a bit, but they won't necessarily fall as much as many are hoping, and they could actually settle at higher levels than um, people are expecting. A lot of people ask me, sort of what's a normal interest rate these days in terms of the OCR, in terms of a mortgage rate. What should I consider normal? At the moment, we know interest rates are higher than normal. And looking back 2 years in the middle of the pandemic, interest rates were lower than normal. So, what's normal? And I think the best way to sort of have a go at guessing about what normal might be is to think about the Reserve Bank's neutral interest rate settings, neutral OCR, and the neutral interest rate is basically the level where the policymakers are not trying to speed up the economy and they're not trying to slow it down. So when you're trying to speed up the economy, you cut interest rates and have them lower. And when you're trying to slow down the economy, you put up interest rates because that sort of, discourages spending, discourages borrowing, just it reins things in a little bit. So, the OCR is sort of like your brake pedal, accelerator pedal. And when you're kind of in the sweet spot, when the central bank is happy with the path of the economy and growth and unemployment and everything, when they're not trying to speed it up, when they're not trying to slow it down, that's sort of when they're at that neutral level of interest rates. And it's a theoretical concept because they usually are trying to speed it up or slow it down. But the Reserve Bank believes that a neutral OCR is about 2%. So that's what they consider normal. So lower than that, they're probably trying to speed things up. Higher than that, like we are at the moment, they're trying to slow things down. And 2% is also their long term inflation target. So what they're basically saying is that if all other things being equal and under steady state conditions, the OCR when it's at neutral should match the inflation rate. So in real terms, it should be zero. It should be the same as inflation. So looking out over the next few years, I would say that neutral OCR is probably closer to about 3% because they're not going to get the inflation rate down to that 2% target immediately. It won't happen overnight. It'll take a bit of work. So in the long term, your neutral OCR is 2%. In the sort of short to medium term, it's higher than that. Let's call it 3% over the next few years. So um, if that's a normal OCR, then where should mortgage rates be relative to that? Well, over the last several years, 6, 7, 8 years, the 1 year mortgage rate has typically been about 2.5% higher than the OCR, and the 3 year rate about 3% higher than the OCR. So, um, if we're saying the normal OCR is 2 or 3%, then the normal mortgage rate is 2.5% odd, 3% odd above that. So 5.5, sorry, maybe sort of maybe 4.5 to 5.5. So let's call it 5%. For what a normal mortgage rate might be, and that's probably not quite as low as some people were expecting to hear. Some people might have thought that normal might have been a little bit below that. So I guess what that means is even though we might have seen the peak in terms of mortgage rates, and from here over time they will drift a little bit lower. They're not likely to go back to those extremely low levels that we got accustomed to during that COVID period. We've also got the election that'll keep prospective homeowners and investors on the sidelines to a degree. The election often does see people a little bit uncertain. They don't really know where the goalposts are going to be. They don't know who's going to be in charge or what some of the policy proposals will look like. So I think that will keep people maybe just a little bit cautious. Um, there has been a lot of policy change in terms of the housing market in recent years. The most significant one was probably the removal of that interest deductibility for investors. So, that's something to watch. If you had a change of government and a national-led government chose to reverse that, that would be a positive for the housing market. But we'll have just have to wait and see how things play out. So I think the election is another limiting factor with just how much of a rebound you'll see and just how quickly. On the other side of the coin, something that I find comforting is that at least we're a little bit further ahead of the curve this time around in terms of the housing market decline. And what I mean by that is we've already seen a lot of heat come out of the housing market already. So if I think back to the GFC, house prices kept rising right up until the end of 2007, and they peaked just as the economy fell into a recession, and then they declined all the way through that recession pretty much. The recession lasted until the middle of 2009, and house prices kept falling right up until early 2009. And when I think about today, it definitely feels as if the roughest patch is still ahead of us in terms of, the economic slowdown, and as sort of all of those interest rate hikes of the last 12, 18 months catch up with us. So it feels like the toughest period is maybe still to come. Um, and against that backdrop, at least the housing market has got in early and fallen by almost 20% in advance, because it's already been falling. It started falling in um, late 2019, and it's spent the last 18 months falling, and we now sort of move into that period of economic sort of difficulty and a bit more challenge there, with a lot of that exuberance having already been washed out. And I think that's comforting, because at least we're not sort of moving into this period with a housing market that's right at the top and that's been sort of firing on all cylinders right the way through. We've already seen a big washout in confidence, and prices have already taken a reasonable hit. So that actually gives me a bit of comfort. Exactly the same when it comes to the share market, because the New Zealand share market peaked in January of 2021, and it's rebounded strongly since the middle of last year, but it's still quite a bit below those January 2021 highs, 10 or 15% below those levels. So you've seen the same thing in the share market. It is adjusted and corrected in advance, before you sort of head into that period of challenging economic times. So, to a degree, for the share market and the housing market, that is all in the price. Maybe not completely. Doesn't mean there won't be ups and downs, but in a big way, I think it's probably already accounted for, which is comforting. So, look, I think the key message that I am trying to sort of relay to people when it comes to the housing market is that there's some good news. We think the bulk of those declines are probably behind us. The market is starting to feel like it's reaching a bottom, a point of stability. That's good. That's comforting. It means homeowners will feel a bit more confident. It should boost sentiment across the economy. I think for first home buyers, you can, um, be a little bit more upbeat about entering the market at a time when things are stable and kind of flatlining or going sideways rather than sort of falling. So that's good. Should be good for activity. At the same time, don't expect a return to those big house price gains from a few years ago. That is not necessarily going to happen immediately. It might be sort of a period of very very modest improvement, or things sort of going sideways for a while, because you still have got some of those headwinds ahead: a slowing economy, rising unemployment, persistently high mortgage rates, the uncertainty of an election, and prices that are cheaper than they were, but are certainly not, cheap or affordable on most measures. So some good and bad there, but as always, I think there's probably a few more positives that we can take from this dynamic that we're seeing at the moment. All right, we'll stop there. Thanks for listening, everybody. As always, if you want to know more, then just get in touch with your Craig's advisor, and we can help in many, many, many ways. So thanks again. Talk soon.
For more insights, visit craigsip.com.